Welcome back to Econ IQ, where every day we bring you deep financial reflections through which we aim to help you grow your wealth, see beyond what others see, move with greater steadiness, and stay in the market for a longer period than they do. In today's video, we must talk about the gold market, which over the past 2 days has left investors swinging between excitement and anxiety until some of them lost their sleep. If you have been following the market over these 2 days, then it is certain that your heart rate has accelerated during the past 2 days. Driven by strong momentum from hedging emotions and geopolitical fears, the gold market witnessed a remarkable upward wave, one that can be described as a positive shock to the markets. Gold did not merely break through strong resistance levels one after another, it also recorded a new all-time high at the level of $4,600. And despite the appearance of some technical fluctuations after touching the peak, the current performance cannot be described except with one word: solidity. The price is holding firmly to the $4,600 level, refusing any deep decline. It is as if gold is standing on the edge of a cliff, declaring to the world, "I still have wide upside room ahead, and I have not yet reached the ultimate sakf." In front of this strong performance, perhaps illogical to some, I believe everyone has 2 big questions that are hard to ignore. The first question: is this hedging wave ignited by geopolitical tensions merely a passing storm, or are we facing a long-term trend? And can this momentum continue, perhaps even intensify, and push gold toward the insane psychological barrier at $5,000? The second question: in a bull market in which the fundamentals have become almost settled, and with central banks around the world racing to hoard gold, for those who have not entered the market yet, or for those who feel their positions are insufficient, how do we determine the appropriate buying point? Do we chase the price now with our eyes closed, or do we calmly wait for a correction that may not come at all? Today, I will take you in this very deep analytical video to dismantle the threads of the scene and reveal the logic behind this move. We will start with the complex global oil strategy of President Trump, Donald Trump. Then we will go back in time to the year 1979, to the era of golden madness, to search for the lessons of history. And in the end, we will reach clear, practical strategies for every investor through the year 2026. This content is heavy and dense with information, so I advise you to listen to it in a quiet place and with full focus. First, where did this hedging wave come from, and why did gold suddenly explode? As I have confirmed to you in previous videos, the direct spark of this wave did not begin from the financial markets, but from American military and political moves in Venezuela. But let me be clear, if you think that moving the US military was only to overthrow Nicolás Maduro, if you think the matter is limited only to Venezuela's oil reserves, then you greatly underestimate the strategic vision of this president, who transformed from a real estate tycoon into a political player. We must look beyond the surface. Venezuelan oil, from the perspective of the United States, is nothing but an entry point or a stepping stone, indeed even a chess piece. As for the real endgame of the United States at the present time, or let us say the pivotal chess piece in Trump's grand strategy, it lies in the Middle East, specifically Iran. Iran is the country that has been a thorn in America's side for decades. But why is Venezuela important with respect to Iran? The entire matter revolves around the anti-United States oil alliance that the 2 countries built over years. Many may not know that Iran and Venezuela, both of which are under harsh US sanctions, have spent years relying on each other. They wrapped around each other seeking warmth and formed a deep bond based on mutual interests. And this is not merely a commercial agreement, it is an alliance of survival. First, there is technical support. Venezuela has oil, but it is very heavy oil that is difficult to refine without special technologies. Here, Iran intervened and provided its expertise in refining and the essential chemical materials required. Thus, Iran helped Venezuela convert this heavy oil into usable products. Second, there is commercial integration. Iran sends gasoline to Venezuela through a massive shadow fleet of oil tankers. This enables them to barter resources and circumvent U.S. sanctions. There is also financial cooperation, as both sides attempt to get rid of the U.S. dollar and use local currencies. This is a direct attack on the dominance of the petrodollar. And the Trump administration views this cooperation as a double threat, so it moved against Venezuela with two clear objectives. First, to overthrow the Maduro regime and install a government loyal to the United States, thereby cutting off Iran's main ally in Latin America. Second, and more harshly, to shut down the channel of joint oil trade between them. This prevents Iran from obtaining vital revenues through Venezuela and effectively starves the opponent economically. Now, the bigger picture is becoming clear, isn't it? Trump is playing a high-risk game. The goal is to zero Iranian oil exports and crush the country's economic foundation. And what makes this scene worrying and exciting at the same time for gold optimists is how much it resembles history. The current situation in Iran shows a striking similarity to the period preceding the Islamic Revolution in 1979. So what does the scene inside Iran look like today? First, a complete economic collapse under intense U.S. pressure. The Iranian rial has turned into something like a toy currency in the black market. Inflation has jumped to around 50%. Savings of an entire lifetime can lose half their value within a single month. High unemployment means that young people can't even buy bread. And this economic desperation is the strongest fuel for civil unrest. And secondly, and more dangerously, we see the tearing of the social fabric. Do you know how the Pahlavi dynasty fell in 1979? It was not a military coup, but a strike by the bazaar merchants in Iran. The merchants are the backbone of society and the artery of the economy. And today, businessmen in the Grand Bazaar in Tehran have begun striking in protest against taxes and the collapse of the currency. This is a scene identical to the winter of 1978.
Finally, there is a power vacuum. The supreme leader is advancing in age, and the succession plan is unclear. Hardliners and reformists are fighting behind the scenes. This kind of political instability often leads to an uncontrollable black swan event. Do you see the picture now? A collapsing currency, merchants' strikes, and a power vacuum. We are in 2026, but the scene looks as if it were 1978 exactly. History does not always repeat itself, but it often rhymes, and for this reason precisely, the gold market can smell blood. Interestingly, 1979 was the launch pad for the last wave of insane upside in gold. It was a historic leap in which gold rose from $100 to more than $800, unleashing the most famous gold mania in financial history. So will history repeat itself? And to what extent does our current situation resemble the past? Let us turn the clock back 47 years to see how that drama developed back then. You will find that the details are strikingly intertwined. In early 1978, the price of gold in London was hovering around $140. Unrest had begun in Iran, and the muqaddamats of the revolution were still at their beginning. The market started to worry about cuts in oil production, and gold prices began to rise. By December 1978, Iranian oil production had fallen by 5 million barrels per day, which ignited the second oil crisis. Oil prices jumped, and gold rose to $244. In early 1979, the government changed, and Iran stopped oil exports for 60 days. The world panicked, and people lined up in long queues at gas stations. In November 1979, the famous hostage crisis erupted, during which 52 hostages were held for 444 days. The U.S.-Iran conflict escalated, and the specter of war became imminent. Gold jumped to $370. Then, in late 1979, exactly when it seemed things could not get worse, the Soviet Union invaded Afghanistan. Cold War tensions exploded and geopolitical shocks accumulated. Gold exceeded $500. Finally, in January 1980, amid a comprehensive panic, gold reached a historic peak at $852. In only 2 years, gold rose by more than 240%. And now we return to 2026. The current gold rally is fueled by the revival of these historical memories. U.S. oil ambitions have not slowed down, and with Trump tightening the noose on Iran, more deterioration in the situation seems almost inevitable. With Trump's unpredictable style, this flight to safety appears as if it is only at its beginning. The market is currently pricing in expectations of a major conflict. But as rational investors, we cannot follow the past blindly. Yes, Iran's situation may push gold to higher levels, but we must be objective. It is unlikely that we will see in 2026 the same eightfold rise that we saw in 1979. There are 4 fundamental differences between the past and the present that must be understood. First, the underlying reasons are different. In 1979, there was an existential crisis. Inflation was eating wealth, the dollar was collapsing, and people were buying gold just to survive. But in 2026, the matter is more about asset allocation. Investors use gold for diversification and to add a layer of protection to their portfolios, not out of desperate panic. Second, the energy landscape has changed radically. In 1979, Iran's exports constituted 10% of global supplies. Today, the United States is the largest oil producer in the world thanks to the shale revolution. Global supplies are more diversified, and OPEC Plus has sufficient spare capacity to fill any gaps. Even if Iran faces problems, it is unlikely that oil prices will double as they did in 1979, which weakens the link between oil prices and gold. Third, the market structure has changed. In 1979, the market was driven by individual speculation and panic buying in a small and weakly regulated market. But in 2026, institutional investors drive the scene through ETFs and futures contracts, making the market more rational. And fourth, and most importantly, banks. In 1979, central banks were largely spectators or even sellers of gold. Today, they are the biggest buyers. China, India, and Turkey are all hoarding gold. This accumulation creates a solid price floor that prevents sharp collapses, but at the same time, it prevents the market from excessive inflation. The core conclusion, 2026 will be characterized by short-term jumps with steady long-term growth, not a boom and bust cycle like 1979. We are facing a bull market that is healthier and more sustainable. And since gold is in a long-term uptrend, the real question is, how do we buy in a market that is easy to rise and hard to fall? How do we determine the entry point? Do we buy now and risk getting stuck at $4,600, or do we wait and risk missing the run towards $5,000? I have 2 strategies, depending on your risk level. If you are a trader seeking quick profits, you must monitor every development related to Iran and every Trump tweet closely. Any news about new sanctions or a military friction in the Gulf is a buying window. In those moments, fear lifts prices, but these are fast-marriage geopolitical pulses. When the news calms or the market gets used to it, prices often retreat. Be flexible, set take-profit and stop-loss levels, don't be greedy, and exit when the noise fades to avoid the correction. My second preferred strategy is long-term investing. Since central banks are buying gold and de-dollarization is a clear trend, gold is the foundation of your portfolio. Gold should be the balancing stone in your portfolio. I recommend allocating 5 to 10% for most investors. Don't worry about $50 fluctuations, whether the price is $4,600 or $4,550 today. Hold it as a hedge against the dollar and black swan events in 2026. The best buying opportunities appear when the news cools down, for example, when a crisis appears to be resolved, or when U.S. economic data improves and the dollar rises, temporarily pressuring gold. That is your opportunity for long-term building. A final warning, despite our positive outlook, do not use excessive leverage. The perfect storm of 1979 is difficult to replicate literally. If you try to get rich overnight, expecting gold to double within a month, normal market volatility will likely force you out. Trump's oil strategy is besieging Iran and feeding gold's momentum. We see the shadows of 1979, but in a new financial era. America's ambitions, Iran's crisis, central banks' concerns, and investors' fear are all pushing this ship towards uncharted waters. Handle these events rationally, benefit from short-term jumps, but focus on long-term value. Do not fall into the trap of buying at the tops and selling at the bottoms. Be a friend of time. Follow the steps of central banks and use pullbacks to improve your average entry. An important reminder, all of this analysis is based on my personal research and current market data to help you cut through the news noise. This is not direct investment advice. That was today's analysis. If this content helped you see something you hadn't noticed before, share your opinion in the comments. And don't forget to like and subscribe to Econ IQ. I will see you in the next episode.